Stop looking at charts. Seriously. Turn them off. They are lying to you. Most people think the stock market is a squiggly line on a screen that goes up when good things happen and down when bad things happen. They treat it like a casino where you bet on red or black. If that's you, you are going to lose your money. The stock market is not a casino. It is a massive global auction house for owning slices of living, breathing businesses. Today, we are going to delete the noise. I'm going to show you the actual engine under the hood that dictates where your money goes. This isn't the textbook definition. This is how it actually works. To understand the trillions of dollars moving on Wall Street, we have to start small. Meet Sarah. Sarah is an engineer in her garage, and she just invented a new type of solar panel that is 50% more efficient than anything else. This is a billion-dollar idea. But right now, Sarah doesn't have $1 billion. She has a soldering iron and some debt. She needs money to build a factory, so she goes to her rich Uncle Bob. Bob gives her $500,000, but he's not doing it out of the kindness of his heart. In exchange, Sarah gives him a piece of paper that says Bob owns 10% of Sarah Solar Inc. This is private equity. It's simple, but Sarah's company gets huge. Now she needs $500 million to build factories globally. Uncle Bob is tapped out. Where do you get that kind of cash? You don't go to one person. You go to everyone. Sarah decides to take her company public. This is the IPO, the initial public offering. Think of an IPO as the world's most hype-filled debutante ball. Sarah hires investment bankers, the party planners of the financial world. Their job is to fly around and convince massive investment funds that Sarah Solar is the future. On the day of the IPO, Sarah's company is sliced up into millions of tiny pieces called shares. And then the opening bell rings on the New York Stock Exchange. Suddenly it's not just Uncle Bob who can own a piece. It's you. It's a teacher in Ohio. It's a hedge fund in London. The very first price of that stock isn't determined by a calculator. It's determined by supply and demand in that exact second. If 1 million people want a slice and there are only 100,000 slices, the price rockets. Congratulations. Sarah Solar is now a ticker symbol. SOLR. Okay, this is the part where most people get confused. And if you understand this next minute, you will be smarter than 90% of beginner investors. Why does Sarah's stock price change every single second? Did her factory burn down at 10:03 a.m. and get rebuilt at 10:05 a.m.? No. Here is the golden rule. The stock market does not care about today. The stock market only cares about the future. Think of it like this. The company's actual business, how many solar panels they sell, is the person walking. It moves relatively slowly and steadily. The stock price is the dog on the leash. It's hyperactive. It runs ahead. It lags behind. It gets distracted by squirrels. The stock price is the collective, real-time best guess of millions of people trying to predict how much money Sarah will make 5 years from now. If a news report comes out that says solar energy is the future, people get excited about Sarah's future profits and they buy the stock now. The dog runs ahead of the owner. If Sarah announces, hey, shipping costs might go up next quarter, people panic about future lower profits and they sell now. The dog yanks back. The price changes because expectations change, not because the business changed that second. So, you see, Sarah's stock is dropping and you think it's a deal. You open Robinhood or Fidelity on your phone, tap buy, and 2 seconds later, you own it. Who did you buy it from? Did you buy it from Sarah? No. She already got her money at the IPO. Did you buy it from Uncle Bob? Probably not. You bought it from someone else who wanted to sell at that exact second. But what if nobody wants to sell right when you want to buy? Does the system break? No. Enter the market maker. These are massive firms that act as the middlemen. They are always willing to buy a stock from you and always willing to sell it to you. If the stock is trading at $100, they might offer to buy it from sellers at $99.98 and sell it to buyers at $100.02. They pocket those few cents in the middle, the spread. They do this millions of times a day. They are the grease that keeps the machine from seizing up, ensuring there is always liquidity, the ability to turn your stock back into cash instantly. So, let's go back to the beginning. Is the stock market a casino? In the short term, over days or weeks, yes, it kind of is. It's an emotional voting machine. The dog on the leash is reacting to fear and greed. But in the long term, over years, it is a weighing machine. Eventually, the hype dies down. Eventually, Sarah either sells millions of solar panels and makes real profits, or she doesn't. Over time, the stock price will align with the reality of the business. If you are trying to guess what the dog will do in the next 10 minutes, you are gambling. If you are analyzing where the owner is walking over the next 10 years, you are investing. The stock market is the greatest wealth creation engine in human history, but only if you respect how it works. It's not about staring at squiggly lines, it's about understanding businesses, understanding value, and having patience. If this video turned on a light bulb for you, if it made the complex seem a little simpler, do me a favor. Smash that subscribe button. Most financial channels just hype the next hot stock to get views. On this channel, we focus on the mechanics, the mindset, and the actual strategies to build long-term wealth without losing your mind. Join the community and let's stop gambling and start investing. Thanks for watching.